Hey everyone, welcome back to our On the Money channel. Matt Stevenson, president of Allied Wealth here. As you're watching the video today, remember to hit the like and subscribe button below. We'll always have more content every week for you. What we wanted to do today is follow up from our previous video where we analyzed Bob and Linda's current holdings in their 401k as we worked towards building a retirement plan for them. And now we want to show you the next step of that, where we're going to put Bob and Linda's retirement to the test in a few different ways, both with what they're currently doing with the 401k and perhaps a few tweaks that we would consider in building our partnership together. And so as we look at that today, the first step will be to see what they're currently doing as we put that plan together. Now, the first step with any plan, as we stress test this in a number of ways, of course, we have their ages here. And in this case, Bob is age 65, Linda is age 60. One of the main things that we want to account for is longevity. And in particular, making sure that our better halves as gentlemen are well taken care of. In this case, Linda is 5 years younger, and based on the statistics, there's a high probability that she may outlive Bob. And so as we build these plans, making sure that these dollars are in place late in Linda's life in particular, that way she has a basket of resources to lean on for those expenses, is crucial in building our plan. Now, as we scoot along here, Bob and Linda mentioned to us that they needed about $100,000 a year net of tax to maintain their lifestyle. And so that is our main goal that we're building into the plan. And much like all of our other clients that come to see us, having those crucial questions of how do I now make it to and through retirement without a paycheck and not run out of money over the next 20 to 30 years in that process. Now, one of the things we have to be mindful of, especially in this environment, is our ugly cousin in the back room, and we call him inflation. Certainly current levels of inflation are astronomically high. Historically speaking, when we look at inflation, it tends to run at about 3%, and that is what we have mapped out here for Bob and Linda. So here it'll show our total expense needs, both in today's dollars, without inflation, and in future dollars, once we account for that 3% inflation rate over a 31-year retirement. Now, you may remember this will basically map out Bob and Linda's current return and risk profile on the 401k plan. And so Bob's annualized return was 6.7. The risk level was 12.4. And here we also have that same normal curve, giving us that basic range of expectations for what the nest egg should do in a given market environment. As we scoot down here, this is where we add in the resources that Bob and Linda have at their disposal to generate income in retirement. And here, as we saw in our last video, Bob has his 401k that he's worked very hard all these years to contribute to, just shy of $1.1 million in this case. And in addition to that, really the foundation of the retirement plan will be our guaranteed sources of income in retirement. In this case, Bob and Linda will have a couple. Not only will they have Social Security for each of them, but also Bob has a pension. Now, with Bob's pension, the only option that was available to him was to take that monthly income stream from the company. Oftentimes, with other folks out there, they give you an option for a lump sum. And one of the things we really want to do there is compare the costs or benefits versus, does it make sense to take a lump sum from the pension and invest that wisely for our future? Or does it in fact make sense to take that monthly income stream for you and your spouse? In this case, what we were able to recommend to Bob and Linda focusing on the pension first and foremost, is that Bob opted for what's called a 100% joint and survivor benefit, meaning should something ever happen to Bob, 100% of that pension income will pass to Linda, and she'll continue receiving those same pension payments as long as she has breath in her body, which is really cool. Now, that pension income as their foundation is $50,000 a year. Unfortunately, most pension plans, if we take that monthly income stream from the company, it doesn't really adjust for inflation, so that is another factor to keep in mind there, folks. A couple of buckets for Social Security. When we mapped out the timing for Bob and Linda to claim their Social Security benefits, what we're able to find in either scenario that we ran is that it makes the most sense mathematically for Bob to claim his Social Security at full retirement age, which for him was $3,000 a month or $36,000 a year. You do get what's called a cost of living adjustment on your Social Security benefits to keep pace at least somewhat with inflation. Historically, that hasn't been the greatest adjustment. The last several years, we're seeing about a 1% jump there on average. For Linda, as a non-working spouse, taking care of the kiddos throughout her life, which is a full-time job in and of itself, of course, she's entitled to what's called a spousal benefit. And so she will be able to claim 1/2 of Bob's benefit at his full retirement age. So 1/2 of that $36,000 equates to $18,000 a year in additional income from Linda's spousal benefit. Now, one of the other things that we wanted to account for, tying back to that longevity conversation, is, what if Linda does outlive Bob by a few years? And so in this case, should Bob pass before Linda, she would also then be entitled to what's called a survivor benefit, in which case she would receive 100% of the benefit that Bob was receiving as the higher wage earner and the higher benefit earner. So here we have essentially 3 sources of guaranteed income: Bob and Linda's Social Security benefits and their pension. Really, again, laying the foundation for their income in retirement, and now using that 401k as additional income to hit those retirement goals to maintain their lifestyle for many years to come. We also have to, of course, account for taxes, especially for Bob and Linda here. Just like many of our clients, they've done an excellent job of saving over the years, but the majority of that has been into pre-tax accounts, such as their 401k. And so any time that we withdraw money in retirement from those pre-tax accounts, whether it is a 401k, a traditional IRA, unfortunately we have a partner in that retirement plan, and that is our Uncle Sam. And so every dollar that comes out will be taxable at your earnings rate. And so here, this is automatically factored into the plan. Of course, in the great state of Texas, fortunately, we do not currently have a state tax. Hopefully it stays that way. And for Bob and Linda, not as much of a concern, but for our folks that have after-tax investment accounts, we also want to account for capital gains taxation and how to minimize that as much as we can. Now, what these plans are going to do for us is take all of these factors into account. Not only the assets that Bob and Linda are working with, the 401k, the pension, the income from their Social Security benefits, but also the ways in which we invest the dollars over time. Really mapping out here what Bob and Linda have done all these years working to manage the 401k on their own so far. And it's going to give us a probability of success to hit those income goals over time. And so what we're able to show Bob and Linda here is that if they make no changes whatsoever and stay on their current path, they have about a 71% chance of hitting that $100,000 net of tax income goal all the way through the plan. In this case, when Linda is age 90 years old. And so certainly some room for improvement here, perhaps. Most importantly, just like we give a range of expectations for what the nest egg should do as far as growth and risk over time, that directly translates to the dollars left over in the plan at the end. And so as we scoot down here, we'll also see a range of outcomes that represents the dollars left in the portfolio at the end of the plan, 30 plus years from now, in a best, expected, and to us, most importantly for planning, a worst case scenario for those dollars left over. Now, we don't tend to focus too much on that best case scenario. This is essentially assuming, folks, that things go extremely well for the market over the next 3 decades. Is it possible? Yes, perhaps. Is it likely? Probably not. And so when we build these plans, in fact, we steer towards the right side of this page more so, because any plan that we want to implement with our clients, we need to make sure that there's a basket of resources late in life for those spouses to lean on. And in this case, if things do go wrong with the market, perhaps the economy over the many years to come, Bob and Linda face a shortfall of about $300,000 when they would need those dollars the most for healthcare, long-term care needs, cash to have on hand in case of emergency, any needs that they would have for late in life. And so the other thing that we were able to identify is that the range of outcomes from best case to worst case is quite variable. It's all over the map, folks. So one of the main tweaks that we wanted to implement with Bob and Linda are some ways to tighten that range of outcomes to get that consistency that we need for the nest egg to grow and to create consistent cash flow for the next several decades. So this is an example of what Bob and Linda are currently doing as we put that to the test. Now let's take a look at some of the things that we considered implementing together as we built our partnership. And this is where we take a bit more of a tactical approach to allocating dollars within the retirement plan. And so it's very much so about how do we adapt to different market environments. We believe very strongly that there are times to press the gas, or when times are volatile, perhaps tap the brakes a bit. Again, seeking to get a good return, seeking to minimize risk, and most importantly, seeking to minimize the potential for loss, or what we call drawdown, as much as we can, so that we can stay on the right path and create an environment to remain successful, no matter what market conditions surround us. So that is more so of this tactical approach that we implement with so many of our clients, and we wanted to show Bob and Linda what this would look like for them. And so as you'll see, most of the plan is identical to what we just showed them with their current set of investments. Of course, their current ages here at the top, still accounting for that longevity of, you know, how do we make it the next 20 to 30 years without that paycheck and not run out of money? So taking that into account, in particular for Linda. And we have our same income goal. So our retirement expenses to maintain the lifestyle beginning this year at a net of tax figure of $100,000 a year, again accounting for a historical inflation rate of about 3%. Now, as we scoot along here, you'll notice one of the differences in this plan and the previous is now we're implementing more of that tactical approach to adapt to market environments and create more consistency. Now, this is where we look to add value for our clients in getting a better return, minimizing risk and potential for drawdown as much as we can. And here, we're able to get Bob and Linda a better rate of return, significantly reduce their risk factor, and here cut their drawdown by about 50%, if not more. And so really creating that environment to remain successful. And we're able to implement that with Bob's 401k, there with the retirement plan. So basically implementing that tactical approach with the 401k now that Bob's looking to retire, and combining that with their guaranteed sources of income. So Bob and Linda each have their Social Security benefits, accounting for survivor benefit later on in life, and the foundation of this plan, Bob's pension, there is that guaranteed income of $50,000 a year. And again, using that 401k as that supplemental income to meet those lifestyle needs. Again, accounting for taxes as we withdraw from those IRAs, those 401ks, we will pay tax on those dollars as they come out for income. So definitely accounting for that as we go. But now what we'll see on the next page is by looking at these small tweaks to what Bob and Linda have been doing for many years, doing an excellent job of building the nest egg and preparing themselves for retirement, we'll see the impact of these small changes. And in fact, it's quite significant. We went from a 71% chance of success with what Bob and Linda were currently doing to now they have utter confidence in building a retirement plan at a probability of success of 90%. And folks, when we build a retirement plan for our clients, we're generally looking for a probability of success somewhere between 85 to 90%. So this is really on the higher end range of that. And what this tells us, in fact, is it's possible that we could afford to spend just a bit more each year in retirement and still be within that comfortable range of success, which is pretty cool. Most importantly, though, as we look at that range of outcomes for Bob and Linda for what's left over late in life, it's a much different picture than what we saw previously. Whereas in that worst case scenario, with their current set of plans, Bob and Linda faced perhaps a $300,000 shortfall later in life. Here, even in that worst case scenario, we're left with a positive figure. And so it may very well be a situation where that last check bounces to the funeral home, but now we've created a plan to get more consistency, minimize these risk factors despite the crazy market conditions that can and will happen, and minimize the chance for loss as much as we can to make sure that Bob and Linda stay on the right track. Folks, if you enjoyed this video, if you want to learn more, remember to hit the like button, subscribe to our page, and we'll be back with more On the Money soon.